the Asian credit market is often not well understood or oftentimes misunderstood by global investors. So as a result, global manager has mostly been underway the market of this part of the world. Okay, so that results in a cheaper valuation of Asian bonds for a very long time in our view. So the recent outperformance of the Asian bond market to us is just a catching up of performance, from the past few years. The answer to it is both yes and no. Yes, because it's, as you mentioned, that a lot of these companies, they are going to onshore to raise funding, and that basically limit the offshore supply of bond in this market. No, if you look at the broker-dealers community post-Lehman, you notice that a lot of these broker-dealers now they are being more selective in serving their client. As you know, post-Lehman era, running a Wall Street sales and trading has become more costly. So they are more selective in the clients they serve. But for us, we are lucky that we haven't seen the kind of impact that, because of the limited supply of bond that impact us. If you look at the Asian credit space, right, investment grade bond, the credit space is roughly, as low 200 basis points over Treasury, whereas high yield bond, we are talking about 300 basis points or above. In particular, in our portfolio, we normally look at position that had at least 700 basis points of credit spread versus the Treasury. So the wider credit spread of high yield bond will serve as a cushion to interest rate shock. I think that, as I mentioned before, the Asian credit market is not well understood and oftentimes misunderstood by global investors. So allocation has been low in this part of the world. So I expect as the Asian and Chinese story is beginning to get better understanding by the global investor, and then that will drive credit spread tighter, and that will result in higher valuation of Asian bonds. So we expect that for Asian bond going forward, we will at least have a stable to even though more outperformance going forward.